Okay, we have a great one here today. This is actually going to be pretty in-depth. We are going to do two type of variations on this. We're going to actually use the one from, in terms of rents, we're going to do market rents from internet search to see what the average internet cash flow would be, or income rather. And then we're also going to gather, we have the OM, or essentially a document that's showing all the your rent and your profit and loss and your P&L and L and so forth. So we're going to compare the two. Okay. So this is going to be very interesting. Okay, so let's start off. This is the unit here. It's in Wolcott Apartments. It's in Denver, Colorado. So I have this cost here as the price, but obviously this is Canadian dollars. So we're just going to go over here and just make the quick exchange. I've actually already exchanged it here. So it's actually 12,500,000. So let's put that in here. Okay, so we're just gonna start off with 20% down. All right, we're gonna interest rate of 5%. Let's just say hypothetically. Okay, we're gonna go with that right now. Okay, so this is actually the mix. I've already put in the mix of the units, and how I figure that out is if you once you come to this property here, we're gonna come down, and most of them have them. There'll be a description here, maybe give you some of the information that you need, but also right here. If you click on the attachments, it will bring up this, which is kind of sometimes it's like a history of the building, shows you pictures of where it's located, things like that. It's actually a really nice building. I'll just show you quickly what it is. It's actually used to be the history of a school. It's a school for girls many years ago, and it's obviously converted to apartments. So it's actually a historical place. It's quite interesting. And so what happens is, let's scroll down here. It's really actually really nice. That's kind of what caught my eye. Looks like there's a lot of attention to detail. Quality is very good. So, and it's situated really close to the city. Okay, so this is actually an ideal location. It's beautiful. And so let me just scroll to here. And also, not many uh, flyers or whatever will show this, but it does have the analysis on here. Okay, so based off, even tells you the current rents per unit, and it has quite a diverse unit mix here, and it also has monthly income and a performance. So they say, okay, this is what the projection might be. But shortly, I'm going to show you what currently online is showing as the current rents and what it is now. It's quite different. Okay. Also has the income, everything involved, laundry, parking, and so forth, property taxes, and all that. We're going to try and simplify that. We're not going to kind of go through all step by step, but we're actually going to try and come up with something similar just to get through this quickly, because if not, we'll be here for a while trying to put all this together. Okay, so we're going to go with 7 units, 27 one bedrooms, four two bedrooms, one three, and one four, according to this roughly. Okay. So what we're going to do is this. We're going to go to the internet. We are going to search. I've already searched here, Denver, Colorado rent prices. Okay, so we're going to go with a bachelor. We're going to go with one studio, and that would be 1364. So we're going to come here. We're going to put in 1364. Okay, we're going to hit one bedrooms, and it's 1638. We're going to come here, 1638. Two bedroom, 2240. And we're gonna go 3 bedroom, 2760. And last but not least, the 4 bedroom. There's one 4 bedroom unit, and it's 2900. Okay. All right. So let's see what this works out to be. Works out to be about 60. According to this, it works out to be about $68,000 a year, or sorry, rather a month, and 820,000 a year. Okay, so we're going to put a 10% vacancy in there. All right, and we're going to come over here. And what we're going to do is this, because we're going to scroll back to this sheet here, and we're going to look at Their monthly I don't want to confuse right now. So what we're going to do is we're going to go back and we're going to redo it with the information here. But I just want to give you an idea as to what their projected gross income, their current income is 705, and we're indicating it's 738 with a 10. Remember, it's 820, but we put a 10% vacancy. They're using a 3% vacancy right here, as you can see, which is kind of unrealistic. Okay, so originally we have 820, 728 as a total yearly income, and they have a 705 current. So their projected actual performance is 750. So 750, 628, which would bring us close to actually a little bit more, obviously, than where our market rents would be um, according to the internet. Okay, so but we're still off in terms of the performa. So we're gonna go and we're gonna take the expenses, the total expenses. I'm just looking here at property taxes, and according to this 1% rule, property taxes per month is 10,000 for 17, right? Second, 10,000 for 17. Looking at 125,000 a year in taxes based off of a $12 million property. They're showing 44,000. I think that's super low. Like that's kind of like point 5%, right? Less than 0.5%, 0.3% or something like that is would be the taxes based off of what they're telling me is the current property tax. I think this is inaccurate, these numbers, okay? And as you can see, look, this is a perfect example. So for example, um, the performa, the expenses is not much different, right? We have a 268 based on current, and if we had the performa put in with all the additional rents, we're not much different, right? So let's go over here and we're gonna go and we're gonna just continue what we have here. But we're gonna put in here, I'm gonna put in here 40%, okay? Plus the 5, right? That's already in there for maintenance. We're gonna leave that in there as 40%, okay? So total income right now is 738 with the vacancy, and 769, about 370,000 in expenses. They're showing expenses as 268. I think that's pretty low. So we're gonna use this number here, okay, as a 40%. So it does tell you here, let me just read down here. Current management expense on the site has on-site manager, including wages, payroll, taxes, workers' comp, insurance, and the value of the department, and the value of the manager's apartment, which includes GSI above. Okay, so it just means that the management expense in here, the 4,000, 41,000 is to pay the on-site manager, his wages, payroll taxes, and all that stuff. Okay. Um, so that's fine. We're just gonna use 45% in this case. Okay. Usually it's around 35 to 50 depending on the property. This is actually a big unit. It's 40 units, so we're gonna actually put something closer to 50%. So I'm gonna put in 45 just to show. Okay, so we're gonna go over here right away. Look at the cash flow we're in. Do you see the debt service per year based off of this number? So we're in a serious negative here. Okay. And I'm gonna show you something that's really interesting. I don't know what they're thinking, but okay. So we're gonna raise the rents 5%. Let's say actually this is performance. So we're gonna leave the rents as current. Okay. But let's leave it at that. So laundry. So laundries they're estimating per year is 3,424, right? So so we're gonna put in 285. Oh, my mistake. Wrong spot. So 285 per month. The parking is 660. So we're gonna look at 550 per month. I'm also gonna put in about 5 pets out of 40 units. I mean, I think it's gonna be much more than that. Just put in 5 just for the sake of this. I might calculates it for you, okay? Tenants pay utilities. We're going to say yes, tenants are paying utilities. Energy efficient lighting. Okay, let's put in 5%. It's a big place, so it looks like we're going to be able to save something there. Lower interest rates. We're not going to get lower than 5%, not in this market. Okay. Increased down payment. All right, so this is where I find it very interesting. Okay, so we have basically a 20% interest rate on this. But if you look over here on the right-hand side, they basically determine, okay, so based off of this, this is the current not operating income, and then the projected debt service is this. Now, how did they get the projected debt service? If you look down here, the loan amount on this property is, if you take out a loan on a mortgage, you're going to take out 5,625,000. But they're come to this assumption. They just pick it. Unfortunately, they picked this number. The seller, I guess, picked this number that if you put down 687,000, right, 875, you're gonna, with a 5.75 interest rate over 30 years, this is what your debt service would be every month, 393,000. But you're putting more than 50% down on this building, right? So this is the only way to make this cash flow. And the cash flow is what? Cash flow before tax is only 46,000. So 40 units and you're only getting 46,000 per year off this. Is this worth it? Is it worth it? And you have to come up with, half of the price. You have to come up with almost $7 million to secure this property. So this is kind of unrealistic. So what I would do is, in this case, what we'll do is we're going to put in. You would have to put in, like, let's say, you have to put in about 55% to see if this cash flow. There you go. See, now it starts the cash flow. You got to put in like 55% or even higher. Let's say 60. There you go. Okay, so this is the kind of number that I'm looking at that I'd be comfortable with in terms of a yearly cash flow. So, but I would have to put in 7,500,000 roughly, according to this price, which means that this price, if you look down here, according to the income on this property, now this is based fully rented. We got market rents on this on every unit, right? And we got market units on every rent, and according to this, what the property is actually worth is about $6 million based off of this income and the cap rate. So I already pre-screened this information. I put the 40 units in here, and this particular area in Denver, Colorado is around 6.5 market cap. Okay, so according to this property is actually only valued at $6 million. So I don't even know where they're coming up with this number, this $12 million number, to be honest with you. But it is a quite, beautiful property. I think it's a great looking property. It looks like it's very well maintained. Again, it's a historical building, so there seems to be some kind of potential here in terms of the property, but I think the valuation is a little bit off. So this is the kind of the way that I think that it would work, right? I mean, that an investor or someone would come in here and say, okay, at least if I'm making 69,000 a year, this might be a doable deal, right? But even here, if you look at here, the deal cap is still, it's not a good deal because it's not all green lit, right? So the deal cap is actually 3.2%, which is lower than the actual market cap of 6.57%, right? So we put it kind of rounds it up, right? We put 6.5 and it rounds it up to the next one above it. And so right now we're at a 3.2 market cap, and look at the cash on cash return. So this is actually not a very good investment. But however, let's see if we can experiment with this. So what we're going to do is this. We're going to go